So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to The Daily Call from Option Alpha. Hey everyone, this is Kirk here again from Option Alpha, and welcome back to The Daily Call. Today we are going to discuss put-call parity, and we're finally going to explain it for you guys, hopefully here very quickly. So the idea behind put-call parity mainly resides with European-style option contracts. So this is opposed to American-style option contracts, which really don't ever reach put-call parity because they have the ability to be exercised ahead of expiration. But European-style options are only exercised at expiration. So you can find instances where the put-call parity actually exists in the contracts. Now, what happens is that in, very simple terms, when you reach put-call parity, it's basically the point at which the options contracts that you're trading are trading almost identical or identical to the underlying asset. So what you typically see with an option contract, say that has a delta of 80, that means that the option contract is going to perform like 80 shares of stock. So it's not going to be like 100 shares of stock, which is ideally what the option contract controls, but it's not going to perform like that. If the option contract starts to move its deltas closer to 1 and -1, then it basically starts acting like you would already have long or short of the underlying asset or futures contract or index. And so that's what happens, is that the put and the call options become in parity with the underlying asset. And so one is basically the same as the other. There's no real difference. Now, if there was a difference to be, gained, maybe the put contracts, had a differential between the calls and the stock, or the call options and stock was different than the actual put contracts, you could probably entertain some arbitrage strategies, but those are probably far and few between. So I wanted to explain this so you guys understand it. In our case, for a lot of the American style options that we trade here at Option Alpha, when you see an option contract go really far into the money, I'll start even mentioning that it's trading closer to parity. It's trading closer to what the actual underlying asset would be. So although some people get really, nervous when they get assigned stock, in many respects, if they have a deep in the money option, it's basically acting like stock already. It's just now they actually have the physical stock in their control. So hopefully this helps out. As always, if you guys have any questions, let us know. And until next time, happy trading. Thanks for joining us on The Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on The Daily Call from OptionAlpha.com.